What if I told you that some of the most profitable traders in the world are wrong more often than they're right? Years ago, I remember sitting in front of my screen after my fourth losing trade in a row, staring at a red account balance and thinking, I must be terrible at this. I had followed the rules, respected my stop loss, and still loss after loss. Meanwhile, online gurus were bragging about 80% win rates, flashing screenshots, and promising near-perfect accuracy. I felt like I didn't belong in trading at all, but then something strange happened. I zoomed out, not on the chart, but on my results. Despite losing more trades than I won, my account was slowly growing. That's when it hit me: trading isn't about being right, it's about being profitable. If you've ever felt discouraged because you don't win most of your trades, stay with me until the end of this video. Because once you truly understand how traders win with just a 40% win rate, you'll never look at losses the same way again. Let's start with a belief that quietly destroys more traders than bad strategies ever will. If I'm not winning most of my trades, I must be failing. Sounds logical, right? I mean, in school a 40% score is a disaster. In sports, winning 4 games out of 10 gets you fired. So naturally, when new traders hear that professionals can win with a 40% win rate, it sounds insane. But here's the uncomfortable question: since when did the market reward people for being right most of the time? To make a long story short, the market doesn't care about your ego. It only cares about numbers. Let's talk about casinos for a second. Have you ever wondered why casinos don't need to win every hand to make billions? In games like blackjack, the casino's edge is often less than 5%. That means players actually win a large percentage of hands. Yet casinos never go bankrupt. Why? Because of expectancy. Expectancy is the average amount you can expect to win or lose per trade over a large sample size. Professional traders live and die by this concept. According to trading educator Van K. Tharp, expectancy is calculated as expectancy. Notice something important here. Win rate is only one part of the equation. Now let's compare two traders. Trader A wins 70% of the time, 100 to make 50. Trader B wins only 40% of the time but risks 100 to make 300. Who do you think makes more money over 100 trades? Lower win rate, 12 times more profit. So ask yourself honestly, would you rather be right often or paid well? This is why professional trend following funds, some of the most successful traders in history, often have win rates between 30% and 45%, according to data from Barclay Hedge and Dunn Capital. Many commodity trading advisors operate profitably with win rates below 50%, relying instead on large winners and controlled losses. And here's where most retail traders get trapped. They chase accuracy. They move stop losses. They take profits too early. Why? Because losing feels like failure. But in trading, losses are not failure, they're rent. Think of it like running a coffee shop. You don't cry every time you pay electricity or staff wages, do you? Those are business expenses. In trading, losses are operating costs. The problem is most traders emotionally treat losses like personal rejection. Now let's slow this down and explain risk to reward in plain English. Risk to reward simply means how much you're willing to lose to make a certain amount. A Fund 3 risk to reward ratio means risking 1 to make 3. With that ratio, you only need to be right 25% of the time to break even before fees. This isn't motivation, it's math. According to research published by the CME Group on futures trading performance, systems with positive expectancy often show lower win rates but higher average wins relative to losses. This pattern appears across futures, forex, and equities. So why doesn't everyone trade this way? Because psychologically, humans hate being wrong. A 40% win rate means most days feel bad. You'll have more red trades than green ones. And if you're emotionally attached to being right, this style will break you. But professionals don't think in trades. They think in batches of 100, 500, or 1,000 trades. 1 trade means nothing. 10 trades mean nothing. Only the law of large numbers matters. Here's a rhetorical question that might sting a little. Are you trading to feel smart, or are you trading to make money? This is also why social media is so dangerous. You'll see ads screaming 90% accuracy strategy, but no serious fund, bank, or prop firm hires traders based on accuracy alone. Prop firms care about drawdowns, risk limits, and consistency. In fact, many prop traders are encouraged to cut losses quickly and let winners run, naturally lowering their win rate. And this brings us to drawdowns. With a 40% win rate, losing streaks are normal. Statistically, even a profitable system can experience 6, 8, or 10 losses in a row. That doesn't mean the system is broken. It means you're human and randomness exists. Most traders quit right before the probabilities play out. So the real edge isn't predicting the market. It's surviving long enough for expectancy to work. That's why position sizing becomes non-negotiable. Risking 1% per trade instead of 5% can be the difference between staying in the game and blowing up during a statistically normal losing streak. And as we move forward, the next thing we need to unpack is why being right feels good but quietly keeps traders poor, while being wrong more often is exactly what allows professionals to scale their accounts over time. Let's go deeper, because understanding why a 40% win rate works is one thing, but trusting it with real money is a completely different battle. Here's the uncomfortable truth most people never talk about: the human brain is wired to misunderstand probability. According to research by Nobel Prize winning psychologist Daniel Kahneman, humans are highly susceptible to recency bias, meaning we give far more emotional weight to recent outcomes than to long-term statistics. That's why 3 losses in a row feel like the strategy stopped working, even if nothing has changed. To make a long story short, your emotions are terrible statisticians. Imagine flipping a coin that pays you 3D every time it lands on heads, but costs you 100 every time it lands on tails. Even if heads only shows up 40% of the time, you'd still be profitable over enough flips. Yet most people would quit after a few tails in a row. Why? Because emotionally, losses shout and wins whisper. This is exactly how low win rate trading systems operate. Let's talk about trend followers, because they are the perfect real-world example. Legendary traders like Richard Dennis, Ed C. Cota, and the Turtle traders openly discussed win rates in the 30–40% range. According to Jack Schwager's Market Wizards, many of these traders made fortunes not by predicting markets, but by catching a few massive trends each year while cutting dozens of small losses. Think about that for a second. Dozens of losses funded by a handful of winners. Now ask yourself a dangerous question: what if your job as a trader isn't to avoid losses, but to protect capital until the big win arrives? This mindset shift changes everything. Most retail traders do the opposite. They hunt for constant validation. Small wins feel good, so they take profits early. Losses hurt, so they widen stop losses. Over time, this creates a system with a high win rate and negative expectancy. According to a 2019 study by the Brazilian Stock Exchange, over 97% of retail day traders lost money after fees over a 300-day period, largely due to poor risk-reward behavior, not lack of intelligence. So let's break down position sizing, because this is where 40% win rate traders either survive or disappear. Professional traders think in percentages, not dollars. Risking 1% per trade means that even 10 losses in a row only puts you down roughly 10%. Painful, yes. Fatal, no. Risking 5% per trade, however, turns a normal losing streak into account destruction. This is why prop firms are obsessed with drawdown rules. Firms like FTMO and TopStep publicly state that traders are evaluated more on risk management than raw profitability. A trader who wins 40% of the time but respects drawdowns is far more valuable than someone who wins 70% of the time but occasionally blows up. Here's where things get interesting. When you combine low risk per trade with asymmetric reward, meaning your winners are much larger than your losers, you create something powerful: time. Time allows probability to work in your favor. Time allows you to survive randomness. Time allows the edge to show up. And this is why professionals never obsess over single trade. Let me ask you this: if a casino panicked every time someone hit a blackjack, would it still exist? Of course not. Casinos trust the math. Traders must do the same. Now let's talk about stop losses, because this is where ego quietly kills profitability. A stop loss isn't there to guarantee a loss, it's there to define risk. When traders remove stops to avoid being wrong, they're unknowingly converting a controlled loss into unlimited risk. According to data from the CFA Institute, the largest retail trading losses consistently come from unbounded downside, not from frequent small losses. In other words, one undisciplined trade can erase months of good trading. Low win rate traders understand this deeply. They accept being wrong quickly. They exit without negotiation. And because their average loss is small, they can afford to be wrong again and again and again. Now compare this to the social media fantasy of high accuracy. If someone truly had a consistent 90% win rate with a scalable system, they wouldn't be selling courses. They'd be managing billions. Even Renaissance Technologies, one of the most successful hedge funds in history, relied heavily on statistical edges and diversification, not perfect predictions. So why does the myth persist? Because high win rates sell hope. Low win rates require maturity. Here's another critical concept most traders never learn: distribution of returns. In many profitable systems, the majority of profits come from a small percentage of trades. A study by J.P. Morgan Asset Management showed that missing just the 10 best days in the market over a 20-year period dramatically reduced returns. That means outcomes are not evenly distributed. Translated into trading terms, most trades don't matter. A few matter a lot. This is why cutting winners early is far more damaging than taking small losses. Yet emotionally, traders do the exact opposite. So the real work of a 40% win rate trader isn't finding entries, it's psychological conditioning. training yourself to stay neutral through losses, training yourself not to interfere with winners, training yourself to follow rules when boredom, fear, and doubt all show up at once. And as we keep going, the next layer we need to break down is how professional traders build confidence, not from wins, but from statistics, and how thinking like a portfolio manager instead of a gambler completely changes the way you experience losses, streaks, and long-term growth. Now let's talk about confidence. Real confidence, not the fake kind that comes from a lucky winning streak. Most traders think confidence is something you feel. Professionals know confidence is something you calculate. This is where statistical thinking replaces emotional thinking. A trader with a 40% win rate doesn't wake up asking, "Will I win today?" Instead, they ask, "Did I execute my edge?" Because once you've proven a system over hundreds of trades, the outcome of any single trade becomes irrelevant. To make a long story short, confidence comes from knowing the numbers, not guessing the future. This is exactly how portfolio managers think. According to data from Morningstar, even top-performing mutual funds experience negative months and sometimes negative years, yet investors trust them because the long-term expectancy remains positive. No one fires a fund manager after one bad week, so why fire your trading system after 3 losses? Let's break this down with an example. Imagine 2 traders. Trader X feels confident after a 6-trade winning streak and increases position size. Trader Y feels nothing, because they already planned for this outcome. Trader X is trading emotions. Trader Y is trading a process. Over time, Trader Y survives. This is why professional traders journal relentlessly, not to record profits, but to track execution. According to research published in the Journal of Behavioral Finance, traders who systematically reviewed their behavior reduced emotional decision-making and improved performance consistency. Now let's talk about one of the biggest misconceptions in trading, that a low win rate means poor timing. In reality, many high-quality strategies are designed to enter early and get stopped out often. Breakout systems are a perfect example. Most breakouts fail. Price pokes above resistance, triggers entries, and then reverses. That's normal. The edge appears when the breakout doesn't fail, and those moves can run for weeks or months. Ask yourself this: would you rather miss the move entirely, or pay a few small losses to catch a massive trend? Trend followers already answered that question decades ago. According to data compiled by the Société Générale Trend Index, trend-following funds have historically performed best during volatile and crisis periods, despite low win rates, because they allow winners to expand dramatically while keeping losses capped. This brings us to the idea of asymmetry. Asymmetry means your upside is larger than your downside. It's the core reason a 40% win rate works. When traders sabotage this asymmetry by moving stops or taking profits early, they destroy the very mechanism that makes the system profitable. And here's where ego sneaks in again. Most traders want to feel clever. They want precision. They want to buy the bottom and sell the top. But markets don't reward clever, they reward discipline. Let me ask you something uncomfortable. If your strategy made money but made you feel stupid most days, would you still trade it? Professional traders say yes. Amateurs quit. Now let's talk about losing streaks, because this is where most people give up right before the edge appears. With a 40% win rate, losing streaks of 5-7 trades are statistically normal. According to probability theory, even a fair coin can land tails 7 times in a row. That doesn't mean the coin is broken. Yet traders react as if the market is personally attacking them. This is why system validation matters. Backtesting and forward testing aren't about finding perfection, they're about understanding distribution. You want to know your worst-case scenarios before they happen in real money. Professional traders ask questions like, what's my maximum historical drawdown? How many losses in a row can this system produce? Can my psychology handle that? Because if you can't handle the drawdown, the system is useless, no matter how profitable it is on paper. This is also why scaling happens slowly. Traders don't double risk because they feel good. They increase size only after the system proves itself across market conditions. According to risk management guidelines published by the CFA Institute, gradual scaling reduces the probability of ruin far more effectively than aggressive position increases. Let's zoom out again. The market is not a test of intelligence, it's a test of consistency. A 40% win rate forces you to detach from short-term outcomes and focus on long-term execution. In a strange way, low win rate systems are safer because they don't tempt you to overtrade or overconfidence. High win rate systems, on the other hand, often collapse the moment conditions change. Now think about this: if your system only works when you're on the zone, is it really a system or just luck? Professional traders build systems that work even when they're tired, bored, or emotionally flat. That's why rules matter more than intuition. And as we continue, The next critical piece we need to unpack is how traders reframe losses, not as pain, but as data, and how treating trading like a probabilistic business, rather than a personal battle, completely transforms both performance and mental health over the long run. Now let's reframe losses properly, because until this clicks, a 40% win rate will always feel emotionally unbearable. Professional traders don't ask, "Why did I lose?" They ask, "Was this loss expected within the model?" That difference sounds subtle, but it changes everything. In probability-based systems, losses are not mistakes, they are data points. According to research published by the Santa Fe Institute on complex adaptive systems, markets behave more like evolving ecosystems than predictable machines. This means randomness is not a flaw, it's a feature. Low win rate strategies embrace this randomness instead of fighting it. To make a long story short, if your strategy requires the market to behave nicely, it's not a strategy, it's a wish. This is why professional traders define success before the trade happens. If the setup meets criteria, the risk is acceptable, and the trade is executed correctly, then the trade is a success, regardless of outcome. This mindset is heavily emphasized in institutional trading training programs and prop firms worldwide. Let's talk about business thinking, because trading is one of the few businesses where people expect to win on every transaction. Imagine a clothing store owner saying, "If every shirt doesn't sell, I'm a failure." Ridiculous, right? Some inventory moves fast, some doesn't. The store owner cares about total profitability, not individual items. Yet traders obsess over individual trades. A 40% win rate trader understands something most people don't: the market pays in chunks. You might lose small amounts repeatedly, then suddenly make back everything and more in a single trade. According to a study by AQR Capital Management, long-term trend strategies often experience long flat periods followed by sharp equity curve expansions. That's not a bug. That's the business model. Now let's address a dangerous habit that destroys low win rate systems: micromanaging trades. When traders stare at charts after entry, emotions creep in. A small pullback feels threatening. A modest profit feels tempting. So they interfere. They cut winners short and let losers breathe, completely reversing the math that made the system work. This is why many professional traders automate exits or use mechanical rules. Not because discretion is bad, but because emotion is expensive. According to data from the National Bureau of Economic Research, overconfident traders trade more frequently and earn lower returns on average than disciplined traders. Confidence without structure is just gambling. Here's a rhetorical question that exposes the core issue: if your system only works when you don't touch it, why do you keep touching it? The answer is psychological discomfort. Low win rate systems force you to sit with discomfort. They force you to watch price move against you, often immediately, without reacting. They force you to accept being wrong early so you can be right big later. And this is exactly why most people can't trade them. Now let's talk about expectancy again, but from a different angle. Expectancy doesn't guarantee profits in the short term. It guarantees profits over enough occurrences. According to probability theory, even a strategy with strong positive expectancy can underperform for dozens of trades. This is called variance. Variance is not risk. Mismanaging variance is risk. Professional traders design systems and position sizes that can survive variance. They assume the worst reasonable scenario will happen and plan for it. That's why risk of ruin calculations matter. According to Ed Thorpe, one of the pioneers of quantitative trading, controlling downside is the single most important factor in long-term survival. This is also why leverage destroys most retail traders. Leverage compresses time. It turns normal variance into emotional catastrophe. A system that works at 1 time leverage can implode at 10 even with the same win rate. Now zoom out with me for a moment. The reason 40% win rate strategies dominate professionally is because they scale. High win rate strategies often rely on precision entries, narrow conditions, or fragile market environments. Once size increases, slippage, liquidity, and execution costs eat the edge alive. Low win rate, high reward systems are robust. They don't need perfection, they need patience. This is why large funds don't try to predict every tick. They participate when conditions align and stay out when they don't. According to BlackRock research papers on systematic investing, robustness beats optimization every time. Let's bring this back to you. If you're struggling emotionally with losses, it's not because you're weak, it's because no one taught you to think probabilistically. Schools teach certainty. Markets operate on uncertainty. So the goal isn't to eliminate fear. The goal is to operate despite it. That's why professional traders reduce decision-making, fixed risk, fixed rules, predefined exits. The fewer choices you make under pressure, the fewer mistakes you make. And here's the irony: once traders truly accept losses as part of the business, the fear starts to fade. Losses stop feeling personal. Wins stop feeling euphoric. Everything becomes neutral. That neutrality is power. As we keep moving forward, the next layer to understand is how traders structure entire portfolios of low win rate strategies, diversifying edges, timeframes, and markets to smooth equity curves and turn inconsistency into long-term dominance across changing market conditions. Now let's expand the lens, because no professional relies on a single setup, a single market, or a single time frame. This is where low win rate trading stops feeling chaotic and starts looking boring in the best possible way. Professional traders think in portfolios of edges. A single 40% win rate strategy can be volatile, but 10 uncorrelated 40% win rate strategies, that's stability. According to research by Markowitz on modern portfolio theory, diversification reduces variance without reducing expected return. This principle applies just as much to trading systems as it does to stocks. To make a long story short, diversification isn't about adding more trades, it's about adding different behavior. One strategy might perform best in trending markets. Another thrives in volatility expansion. Another benefits from mean reversion failures. Individually, they feel inconsistent. Together, they smooth the equity curve. This is exactly how systematic funds operate. According to a white paper by Man Group, large CTA funds trade dozens of markets across multiple timeframes using similar low win rate logic. The goal isn't to avoid drawdowns entirely, it's to prevent any single environment from destroying the account. Now let's talk about correlation, because this is where many traders unknowingly sabotage themselves. Trading 5 strategies on the same index, same time frame, and same session is not diversification, it's concentration. When the market shifts, everything stops working at once. Professional traders intentionally seek uncorrelated returns, different instruments, different volatility profiles, different catalysts. Ask yourself this: if all your trades lose on the same day, do you really have multiple strategies? This is also why low win rate traders are comfortable sitting out. They don't need constant action. Overtrading is a symptom of emotional discomfort, not opportunity. According to data from the Financial Conduct Authority in the UK, excessive trading frequency is one of the strongest predictors of poor retail performance. Now let's talk about timeframes. Lower timeframes often produce higher win rates but smaller rewards. Higher timeframes produce lower win rates but much larger moves. That's not coincidence, it's structure. Professional traders often combine both, using short-term strategies for cash flow and long-term strategies for equity growth. This is another reason 40% win rates persist. Higher time-frame trades naturally take more attempts before a trend develops. But when it does, it pays for weeks or months of losses. Think about legendary investors like Jesse Livermore. He famously said that sitting, not trading, made him the most money. His win rate wasn't high. His winners were massive. Now here's something most people never consider: market regimes change. What works in a low volatility environment may struggle in high volatility. This is why professionals avoid over-optimization. According to research published in the Journal of Financial Markets, overly optimized strategies perform well in backtests and fail in live markets. Low win rate systems are often simpler, fewer rules, broader logic. That simplicity makes them adaptable. This is also where patience becomes a competitive advantage. A trader with a 40% win rate must wait for alignment. They must allow trades to fail quickly and let winners mature slowly. In a world addicted to instant feedback, this patience filters out most participants automatically. Here's a rhetorical question worth sitting with. If your strategy needs constant tweaking to survive, does it really have an edge? Professional traders update systems slowly and deliberately. Changes are tested. Data is respected. Impulses are ignored. Now let's talk about scaling, because this is where low win rate strategies quietly shine. Scaling doesn't mean doubling size overnight. It means increasing exposure as confidence in the process grows. According to risk management literature from the CFA Institute, geometric growth comes from consistent position sizing, not from aggressive bets. When traders with low win rate systems scale, they do it by adding markets, not risk, more opportunities, same discipline, same rules. This is how traders go from surviving to thriving. And here's the final mental shift in this segment: to detachment. Professional traders detach from money. They think in R multiples, units of risk, not dollars. A loss is 1, a win might be FUFI R. This abstraction reduces emotional volatility and reinforces discipline. According to trading psychologist Brett Steenbarger, traders who focus on process metrics outperform those who focus on P&L. Money is an outcome, not a control variable. So when you look at a 40% win rate system and feel uncomfortable, that discomfort is information. It's telling you that the system is forcing you to grow beyond emotional habits. And as we continue, the next critical piece we'll unpack is how traders mentally survive long, flat periods when nothing seems to work. why boredom is often a sign you're doing things right, and how professionals stay engaged without sabotaging their edge during the quiet, unglamorous phases of market cycles. Now let's talk about the phase that silently eliminates most traders. Not losses, not drawdowns, but nothing happening. Flat periods. This is where 40% win rate traders are truly tested. You can survive losses because at least something is happening. You feel engaged, you feel involved. But flat periods, weeks of small losses, break-even trades, or no valid setups at all, that's psychological torture for most people. And yet, this is where professionals separate themselves. To make a long story short, boredom is not the enemy, impatience is. According to a study published in the Review of Financial Studies, traders are more likely to violate their rules during periods of low market activity than during high volatility. Why? Because the brain craves stimulation. When the market doesn't provide it, traders manufacture it. They force trades. Low win rate strategies require waiting for conditions, not opportunities. And conditions don't care about your rent, your emotions, or your need to feel productive. Here's a powerful reframing: flat periods are not pauses in your trading career, they are part of the edge. Why? Because most traders can't sit still. Every day you don't overtrade is a day you're avoiding negative expectancy behavior. According to data from Interactive Brokers Trader Behavior Reports, accounts with lower trade frequency consistently outperform hyperactive accounts over long periods. Silence protects capital. Now let's talk about boredom-driven mistakes, because this is where discipline collapses. During flat periods, traders start tweaking rules. They lower standards. They enter earlier. They justify trades that almost meet criteria. And slowly, without noticing, they turn a statistically proven system into random gambling. Ask yourself this honestly: how many bad trades came from boredom, not signals? Professional traders combat this by creating non-trading metrics. They track rule adherence, patience, preparation, and execution quality. These metrics give the brain something to win at even when money isn't moving. This is why institutional traders are given structured routines: market prep, review sessions, post-trade analysis. The goal is not excitement, it's consistency. Now let's connect this back to the 40% win rate. Low win rate systems naturally produce fewer winners. That means long stretches where confidence is tested, not by losses, but by doubt. Doubt whispers, maybe this doesn't work anymore. Doubt is far more dangerous than fear. According to behavioral finance research, uncertainty triggers stronger stress responses than known negative outcomes. That's why traders often abandon systems before the profitable phase returns. This is where historical data becomes an anchor. Professionals constantly revisit long-term performance data, not to predict the future, but to remind themselves that current discomfort is normal. They trust the sample size, not the feeling. Here's another uncomfortable truth: most profits come after the period where quitting feels rational. Markets move in cycles. Volatility compresses, then expands. Trends disappear, then explode. A 40% win rate trader positions themselves before expansion, not after confirmation. That means paying small costs in advance. This is why breakout traders accept repeated small losses. They're paying an insurance premium for access to rare but powerful moves. When volatility returns, they're already in the game. Now let's talk about identity, because this matters more than strategy. Retail traders often identify as someone who wins. Professional traders identify as someone who executes. That identity shift removes emotional dependency on outcomes. If your self-worth rises and falls with your win rate, a 40% system will destroy you emotionally. But if your self-worth is tied to discipline, the system strengthens you. This is also why many professionals reduce screen time. Staring at charts amplifies emotional noise. Decisions should be planned, not improvised. According to studies on decision fatigue, the more choices you make, the worse those choices become. Low win rate traders intentionally reduce decisions. Less interference, more consistency. Now zoom out one last time in this segment. A 40% win rate is not a weakness, it's a filter. It filters out people who need constant validation. It filters out impatience. It filters out ego. What remains are traders who can think in probabilities, survive boredom, and respect math over emotion. That's why this model persists across decades, instruments, and market regimes. And as the script continues forward, the next layer to unpack is how traders transition from trusting a 40% win rate system to scaling confidence, how they gradually increase exposure without emotional distortion, how they maintain humility during winning streaks, and how long-term traders stay grounded even when the numbers finally start working heavily in their favor.